Hello and welcome back to Financial Freedom Hub. In today's video, we will talk about the concept of equity bonds, and how this concept has made Warren Buffett super rich. Warren Buffett uses this concept when he buys entire businesses, or when he buys a part of the company via stock market. The best part is that you can do the same. So, our today's video will be about shares of those companies that have durable competitive advantages. Those companies continue to increase their earnings per share, EPS, over time, either by increasing their business, purchasing new businesses, or buying back their own shares, using the cash they have earned from their business. With each year that passes, the increased earnings translate into increased return from the initial investment. To learn how exactly you can determine if a company might have a durable competitive advantage, you might want to check out our playlists about how to interpret any company's income statement, balance sheet, and cash flow statement. Companies with durable competitive advantages tend to have characteristics that are laid out in videos of those playlists. Before we start, here is a reminder: if you haven't already, you might want to subscribe to our channel so you won't lose it among millions of other great channels. Now, let's get started. It's not the dividends that the company pays to its shareholders that make a company share-like bond. Instead, it's the strength and predictability of their earnings. If the company has a competitive advantage over its rivals, its earnings are so strong and predictable that for the investors, its shares are like bonds, and the company's pre-tax earnings is a coupon or interest payment to its bondholders. We will explain this concept with an example, so you will understand exactly what it means. But first, if you don't know what bond is, let's look at the definition, according to Investopedia. A bond is a fixed-income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors to the issuer. How can a share of a company be better than a bond, you might ask? It's because unlike ordinary bonds that have defined maturity and fixed interest, these equity bonds have an indefinite lifetime and ever-increasing coupon/interest payments. Let's look at Coca-Cola for example. If we take Coca-Cola's pre-tax earnings of $2.99 per share, we can see that at the current share price of $59, we get 5% annual return. Now, let's calculate average growth rate for 10-year period for 2014 to 2023, and we get 3.3% a year. So, we just found out that if we bought Coca-Cola shares at $59 a share, we would receive an equity bond with 5% coupon payment that grows 3.3% a year in average. Please keep in mind that we are not giving an assessment to the rate of return. But hopefully you get an idea how the relationship between pre-tax earnings and share price can help you to make good investment decisions. To make assessments, you should always take into account the risk and return expectations and your unique personality traits. For example, for value investors, 5, 10, or 20% return is not interesting. This is because they don't plan to hold the stock for more than a few years and all they care about is share price. Similarly, traders don't find it interesting because all they are interested in is share price volatility. But if you plan to hold the position for 20 years or more, the growth rate of your initial investment will compound. The more you hold, the bigger the return and the faster the growth. The equity bond concept can also help us to evaluate the current share price of a company. Historically, the market has evaluated companies approximately at the level of average long-term corporate bond rates of the industry. Let's recall what we learned about the Coca-Cola, and let's play with the numbers. Consider this: at the time of making this video, the long-term average for Moody's seasoned AAA corporate bond yield is approximately 6.46%, while current rate is about 5.05%. We can calculate the value of Coca-Cola's pre-tax earnings on the basis of the long-term corporate bond interest rate. Let's divide Coca-Cola's pre-tax earnings of $2.99 by long-term corporate bond average rate of return 6.46%. We get $46. And if we divide the same pre-tax earnings by the current rate of 5.05%, we get $59.20. Again, please be aware that this video does not provide investment advice. Its main goal is to provide insights to the reasoning behind the decisions made by the world's best investors when they evaluate the price, when they buy either a whole business or a portion of it. Thank you for watching. If you found this video useful, don't forget to like, share, and subscribe to our channel. Until next time, keep learning and stay inspired.